Good morning and welcome to The Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Friday, July the 24th, 2026, and we have a loaded show this morning. Oil briefly crossed $100 a barrel, the S&P and Nasdaq took a serious hit Thursday, and there's a heavy slate of macro data and earnings to navigate. Let's get straight into it. Lizzie, big picture. Oil, yields, geopolitical risk, all hitting at once. How are traders framing this heading into today's session?
Morning, Robert. Thursday was a rough session. The S&P 500 fell 1.2%, the Nasdaq dropped 2%, and the Dow lost around 1%, with Brent crude briefly topping $100 a barrel following Houthi attacks on Saudi tankers and escalating US-Iran military exchanges. The 10-year Treasury yield pushed to a two-month high near 4.65%, and money markets are now pricing roughly a 35% chance of a Fed rate hike at next week's meeting, up sharply from about 10% just 1 week ago. This morning, futures are recovering modestly. Dow futures up around 0.4%, S&P futures up 0.2%, as oil eases back toward 98.90, but the overall mood remains fragile, and traders are staying cautious ahead of today's PMI data and next week's hyperscaler earnings.
Trump also dropped sweeping new tariffs on roughly 60 countries. How much extra pressure does that add on top of everything else?
It compounds the inflation and rate outlook uncertainty significantly. Tariffs of 10 to 12.5%, replacing the previous flat 10% global rate, means broader price pressure across consumer goods, and with oil already stoking inflation fears, the combination gives the Fed very little room to stand pat. Retail sentiment on SPY and QQQ has already dropped to extremely bearish territory, and that tariff headline landed at exactly the wrong time, given where yields are sitting.
Alphabet dropped between 6 and 8% after earnings, with brokerages cutting price targets. What specifically spooked the street?
The core issue was hyperscaler capital expenditure. Alphabet's surging Capex raised legitimate questions about whether AI infrastructure spending will translate into returns quickly enough to justify the outlay, and multiple brokerages cut price targets in response. The broader concern is that investors are starting to demand evidence of monetization, not just investment intent, and the Roundhill Magnificent 7 ETF fell about 4.4% on the session, on pace for its biggest single-day loss of 2026, with Amazon, Meta and Microsoft all dragged lower in sympathy.
Tesla was down over 14%, yet ARK Invest stepped in and bought around 160,000 shares. What does that divergence tell us?
It tells you the market is split between near-term fundamental reality and long-term thesis conviction. Tesla posted negative free cash flow of $1.1 billion. And while there was a $1 billion mark-to-market gain on SpaceX holdings, the underlying business disappointed badly enough to drive that 14% sell-off. ARK's purchase signals they see current prices as a structural entry point on autonomy and robotics, but the broader market is clearly not there yet. Tesla is now down 30% year-to-date, making it the worst performer among the Magnificent Seven.
Intel was the clear bright spot, up on 25% year-on-year revenue growth. Does that change anything for the semiconductor trade?
Intel's print is meaningful because it demonstrated that AI-driven chip demand is real and broad enough to lift a company many had written off as a turnaround story. And it provides some balance to the Alphabet Capex concern narrative. The spending is landing somewhere and Intel is one clear beneficiary. That said, Micron had a strong Thursday session, but then fell nearly 3% overnight, tracking a sharp sell-off in South Korean equities led by Samsung and SK Hynix, and that Kospi correlation has become tight enough that traders are now watching it as a leading indicator for MU specifically, with the $1,000 resistance level remaining the key technical hurdle to reclaim.
Lockheed Martin surged over 10% on earnings. With tensions this elevated, is defense a trade traders should be leaning into more seriously?
Lockheed's move, alongside United Rentals up over 10%, and the broader geopolitical backdrop, does make defense a credible sector allocation right now. When Middle East tensions drive oil above $100 and US-Iran military exchanges are ongoing, defense contractors historically see sustained earnings support, not just a single-day pop. Newmont is a slightly different story. It beat earnings despite weaker gold prices and an earthquake, but sold off anyway after a nearly 60% run over the prior year, and that looks like a clean sell the news reaction rather than fundamental deterioration, though traders should watch whether gold prices stabilise before re-entering.
Steve, yesterday's initial jobless claims were a significant surprise. Walk us through the numbers and what they mean for the Fed right now.
The print was genuinely notable. Initial jobless claims for the week ending July 18th came in at 187,000 against a forecast of 212,000 and a prior reading of 209,000. So we came in 25,000 below consensus and well below the previous week. That is a very tight labor market signal, and it arrives at the worst possible moment for anyone hoping the Fed stays on hold, because it removes one of the key arguments for patience, namely that the labor market was softening enough to offset inflation pressures. With oil-driven inflation re-accelerating and rate hike odds already jumping to around 35% ahead of next week's meeting, a labor market printing this strong gives hawks real ammunition, and markets are right to take it seriously.
And we're getting preliminary July PMI data today. What are you watching for in this release?
The June composite PMI came in at 50.2, supported by solid services activity and continued manufacturing expansion, so the baseline is reasonably healthy going into today's read. What I'm focused on is whether the manufacturing component shows any early impact from the tariff announcement and whether services activity is holding up given the consumer confidence risk from higher energy prices. A reading that holds above 52 will reinforce the strong labor data and push rate hike odds higher still, while any softness in forward-looking components like new orders and business expectations would give the Fed more reason to stay cautious despite the inflation pressure. Given everything happening with oil and tariffs simultaneously, this release carries considerably more weight than a typical mid-cycle PMI update.
Lizzie, with Microsoft, Meta, Amazon, and Apple all reporting next week, how are traders positioning around AI hyperscaler earnings after the Alphabet Capex shock?
The Alphabet result has reset expectations meaningfully, and traders are heading into next week's reports with a much sharper focus on return on AI investment, rather than just the size of the spending commitment. The risk is that any company signalling continued aggressive capex without clear near-term revenue payoff gets the same treatment Alphabet received, and Microsoft and Meta are the most closely watched given their AI exposure. The smart money appears to be reducing exposure ahead of the prints rather than chasing into them, which explains why the MAG's ETF saw such broad selling across names that hadn't even reported yet.
Over to crypto. Bitcoin is range-bound near $65,000 and crypto-linked equities were broadly in the red Thursday. Does the new $15 million Bitcoin security consortium with BlackRock, Fidelity, and ARK move the needle for traders?
In terms of short-term price action, not significantly. Bitcoin dipped from around $65,800 to $64,600 before recovering to roughly $65,500. And the consortium announcement didn't arrest that volatility. But structurally it matters, because it signals the largest institutional names in traditional finance are committing real capital to Bitcoin's long-term infrastructure, including post-quantum cryptography research. US spot Bitcoin ETFs have now recorded 7 straight sessions of inflows totaling nearly $1 billion, recovering about 22% of June's outflows. And analysts at KT3 Research view that as the most encouraging near-term stability indicator, though crypto quant data shows demand from long-term holders is declining, meaning price is currently being supported by traders rather than fresh institutional capital.
The Clarity Act Senate odds briefly crossed 50% on Polymarket before pulling back, and there are arguments that ETH and XRP are breaking out relative to BTC. Is the altcoin rotation real or just noise right now?
There are real signals worth watching. ETH and XRP have been outperforming BTC on both daily and weekly timeframes, with ETH currently around $1,081, and analysts citing $1,150 as the critical support level, with $2,300 as the next upside target if that floor holds. Grayscale formalizing quarterly staking payouts for its ETHS and SOL ETFs from around August 7th adds a genuine yield component that could attract institutional inflows. And SOL has also shown relative strength. The Clarity Act is the key variable. When Senate odds crossed 50%, Bitcoin briefly pushed to $67,000, which confirms the legislative catalyst is real. But in this risk-off environment driven by oil and geopolitics, traders should treat the altcoin rotation as a conditional trade rather than a confirmed trend.
Steve, the ECB held at 2.25% yesterday, but markets are pricing a September hike, and Fed hike odds are rising here at home. Are we heading back into a synchronized global tightening environment?
The conditions for it are genuinely assembling. The ECB held as expected but left September firmly on the table, with Eurozone inflation at 2% annually and European natural gas prices surging over 9% year-to-date as LNG supply through the Strait of Hormuz faces ongoing disruption, while EU gas storage sits at just 54% versus a seasonal average of 70%, which is a meaningful supply risk heading into winter. On the U.S. side, a jobless claims print of 187,000 combined with oil near $99 and tariff-driven price pressure makes the Fed's path considerably more complicated. If today's PMI data confirms economic resilience and next week's Fed meeting rhetoric turns more hawkish, we could be looking at 2 major central banks tightening simultaneously. And historically, that combination creates meaningful headwinds for risk assets and equity valuations globally.
That wraps up today's Morning Bell. This is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. Have a great Friday, everyone.